Welcome to this Killick Explains video, and welcome to a topic which is certainly making the headlines at the moment, and that is inflation. Will it return, and for how long? Or will we see the opposite, deflation? Now, to help me answer this question, I set a poll recently and got a very good response to it. The question I asked was what people expect to happen in inflation terms as we look ahead beyond the pandemic. And I got 4 possible answers. The top one was people who thought inflation will rise persistently but fairly slowly from here. That was 36.5% of the people who responded. I'll come back to that in just a moment. Second answer I offered was we'll have a short-term spike in inflation but nothing longer term than that. And that was 17% of respondents. They thought that was the most likely outcome. And then we turned to 2 answers which are rather different. Those people who think inflation will stay low, and what I mean by that is the West has had a largely low inflation decade. Places such as Europe have flirted with even deflation, and Japan has struggled to shake that off for 2 decades or more. So inflation staying low for most of the Western economies in particular, around 21% of respondents. And then a quarter of people who responded to this poll foresee deflation once the initial boost, if you like, caused by consumers unlocking their post-pandemic savings has faded. So let's just go back through this. Now, first of all, what is inflation? Inflation is the speed at which the price of goods and services rises. Deflation suggests they fall, but rises over time. And without going into the measurement detail here, people who think that inflation is set to rise from here are those people who probably see 2 forces colliding. One is consumers spending their savings post-pandemic, a consumer boom, if you like, but coming head to head with global supply shortages. So business investment and consumer spending hit with supply shortages caused by a lot of mothballing during the pandemic. So as mines are frantically reopened, you get a short-term shortage of things like copper, the oil prices spiked and so on. So evidenced by the commodity prices rising sharply, and therefore prices for things like microchips also rising sharply, some people foresee trouble ahead in the form of inevitable inflation. And that will lead to wage negotiations. Wages are a key indicator for me that inflation is in fact taking off. And that is something proponents of this argument say is no bad thing, provided it happens in a controlled manner. I mean, central banks such as the Bank of England want positive inflation. 2% is the target here, similar level in Europe. Why? Well, heavily indebted governments benefit from inflation, as do heavily indebted consumers and businesses. It erodes the real value of debt, as it's known, and it's something which psychologically most of us are used to. Prices rising steadily means that we should expect some sort of pay rise at the end of the year, and that engenders confidence both for businesses looking to invest and consumers looking to spend. Now, what you don't want, of course, is hyperinflation. So it's a tricky balancing act that central banks have got here when it comes to setting interest rates. Hyperinflation is a rapid rise in prices, and at that point central banks will have no option probably but to cut it off by raising interest rates and throwing quantitative easing into reverse, something called quantitative tightening. And essentially that's a problem because suddenly then borrowing costs could spike for both businesses and consumers, and that could tip us back into a very low or stagnant growth environment. So what about those people who actually think, well, we may get a spike in prices, we may get a consumer boom in the short term, but it's all going to end rather glibly looking further out? Well, these are people probably looking at various other forces at work, and unemployment is potentially one of them. As state support for businesses comes to an end, furlough schemes in the UK come to an end, some people foresee trouble as people are weaned off furlough schemes and potentially lose their jobs. An unemployment spike could certainly put a dampener on consumer spending, as could the fact that increasing numbers of consumers, according to the FCA, are under what's called financial duress at the moment. So the unfortunate ones in the pandemic who may have lost their jobs or gone part-time or self-employed and loss contracts, for them things don't look so rosy, and for the wider economy that could also hold true. Second argument is that with ageing populations, we've had a period where consumers net are shifting from spending to saving, and that long-term structural shift is deflationary, and that's not gone away. Nothing has changed. So after a short-term spending splurge, you could see people reining back, and that would have deflationary consequences. Thirdly, businesses may not gear up fully to meet demand, hence the inflation spike argument, and may in fact be reluctant to commit to long-term investment. Part of the reason why in the recent UK budget there were incentives for businesses to do precisely that. Now, deflation, you might think superficially, if you're about to spend money, is a great idea, but it isn't. It does mean that prices fall, not just for single items but across the economy as a whole. But why is that bad news? Well, it's bad news because if consumers start to anticipate falling prices, they may stop spending, expecting to be able to buy things cheaper, say a year from now. So that's not good news from a growth perspective. And of course, deflation across the economy suggests that people should be negotiating wage cuts, not wage increases. And again, psychologically, if nothing else, that's not something we're used to. Also, without any inflation, for reasons I won't go into in detail here, businesses are arguably disincentivized from taking risk and investing money. So, it's to be hoped that central banks can keep the inflation ship steady. A small amount of positive inflation is a reasonable outcome, but they have to be on guard for either inflation spiralling out of control on the upside or tumbling back into deflation on the downside. For investors, by the way, none of this is a great cause for concern. There is no absolute historic pattern that says inflation is good or bad news for shares. Some sectors certainly benefit more than others in an inflationary environment, but it's certainly not the case that you can say inflation is bad for shares, although that doesn't stop some people trying to say precisely that. And the other thing to bear in mind is that over the long term, equity investments tend to pay back in either inflationary or deflationary environments as long as investors hold on to the right long-term approach. Now, to find out more about what that approach might be, and also some of the stuff I've been talking about here, please do go to our extensive library, killick.com/learn. And if you'd like a copy of my guide, How to Invest in Equities, especially if you're relatively new to this, then please do email me, editor@killick.com.